In the bustling world of finance, where fortunes are made and lost with the blink of an eye, astute investors seek strategies to navigate market complexities. One approach stands the test of time: value investing. Rooted in intrinsic worth and prudent analysis, it guides investors to hidden gems. Value investing is not about chasing trends or market hype. It's about understanding the businesses behind the stocks, seeking companies whose intrinsic value is higher than their market price. This discrepancy presents opportunities for value investors. Like treasure hunters, they meticulously analyze data to uncover undervalued assets. It's a long-term strategy rewarding those who recognize true business worth. Our exploration of value investing begins with its fundamental philosophy. We will unravel the concept of margin of safety, buying assets at a discount to their intrinsic value. This margin of safety acts as a buffer, protecting investors from market fluctuations. By understanding this principle, investors can minimize risk while maximizing returns. Next, we'll equip you with key models to identify undervalued stocks. From discounted cash flow analysis to the price-to-earnings ratio, we'll break down these methods with clear examples. We'll delve into the philosophies of legendary investors like Warren Buffett and Benjamin Graham. To bring these concepts to life, we'll examine real-world examples of value investing in action. Through case studies of companies like Apple, Ford, General Motors, and Bank of America, we'll showcase how value investing principles generate significant returns. Finally, we'll explore value investing's relevance in today's market. At the heart of value investing lies a fundamental concept that sets it apart from other investment philosophies: intrinsic value. Unlike market price, which reflects the current sentiment and trading activity surrounding a stock, intrinsic value represents the true worth of a business based on its underlying fundamentals. It's the present value of all the future cash flows that a company is expected to generate over its lifetime. Think of a company as a fruit-bearing tree. The market price is like the price tag someone puts on the tree based on its current appearance, rumors about its fruit, or the general demand for trees in the market. Intrinsic value, however, is like assessing the tree's health, the quality of its soil, and its potential to bear fruit year after year. It's a more holistic and accurate measure of the tree's true worth. Value investors believe that the market price and intrinsic value of a company can diverge significantly in the short term due to various factors like market sentiment, investor behavior, or economic fluctuations. This divergence creates opportunities for savvy investors to purchase undervalued companies, those whose market price is significantly lower than their intrinsic value. Just as a skilled gardener can spot a healthy tree with the potential to bear abundant fruit, value investors use their analytical tools and market knowledge to identify companies whose true worth is not reflected in their current market price. By understanding a company's business model, competitive landscape, financial health, and future growth prospects, they can estimate its intrinsic value and make informed investment decisions. Imagine you're buying a used car. You wouldn't want to pay the sticker price without first inspecting the engine, checking for rust, and taking it for a test drive. You'd want a margin of safety to account for any potential problems that might arise. Value investing applies the same principle to the stock market. The margin of safety, a cornerstone of value investing popularized by Benjamin Graham, refers to the difference between a company's intrinsic value and its market price. It's the cushion investors build into their purchases to protect themselves from unforeseen circumstances, market fluctuations, or errors in their analysis. Think of the margin of safety as a financial safety net. By buying stocks at a significant discount to their intrinsic value, investors create a buffer that limits their downside risk. Even if their initial analysis proves to be slightly off or the market takes an unexpected downturn, the margin of safety provides a level of protection, reducing the potential for significant losses. The size of the margin of safety varies depending on the investor's risk tolerance, the company's industry, and the overall market conditions. In general, the greater the uncertainty surrounding a company's future prospects or the more volatile the market, the larger the margin of safety investors seek. This cautious approach ensures that even if unforeseen challenges arise, the investment still holds intrinsic value. A long-term perspective riding out market volatility. Value investing is not a get-rich-quick scheme. It's a patient and disciplined approach that requires a long-term perspective. Value investors understand that the market is driven by emotions in the short term, leading to periods of irrational exuberance and pessimism. Instead of getting caught up in the daily fluctuations of the market, they focus on the underlying fundamentals of the businesses they invest in. Imagine a ship navigating a stormy sea. The waves might toss the ship back and forth, but the captain's focus remains on the compass and the destination. Similarly, value investors weather market storms by staying true to their investment philosophy, holding on to their positions even when the market turns against them. This long-term perspective allows value investors to ride out market volatility and capitalize on opportunities that arise when others panic. They understand that the market price of a company can remain detached from its intrinsic value for extended periods, but eventually the two will converge. Their patience is rewarded when the market recognizes the true worth of the undervalued companies they hold, leading to significant capital appreciation. Furthermore, a long-term approach allows value investors to benefit from the power of compounding. By reinvesting their dividends and holding on to their investments for extended periods, they allow their returns to compound over time, generating exponential growth. This patient and disciplined approach is a key driver of long-term wealth creation in value investing. Discounted cash flow, DCF, peering into the future of cash. Imagine you're considering buying a vending machine business. You'd want to estimate how much cash it could generate in the future. The DCF model estimates a company's intrinsic value by forecasting future cash flows and discounting them to present value. A dollar today is worth more than a dollar tomorrow due to the time value of money. By discounting future cash flows, we account for the opportunity cost of investing that money elsewhere. The discount rate reflects the investor's required rate of return, considering factors like risk and inflation. If the calculated value exceeds the market price, it signals potential undervaluation. Price-to-earnings ratio, PE ratio, a measure of value for every dollar earned. It compares a company's share price to its earnings per share, EPS. It tells you how much investors are willing to pay for every dollar of earnings. A lower PE suggests undervaluation, while a higher PE might indicate overvaluation. Think of it as a price tag on a company's earnings. Section 3. Free cash flow, FCF, the lifeblood of business growth and flexibility. Imagine a company as a thriving tree, drawing nutrients from the ground to fuel its growth. Free cash flow, or FCF, represents the lifeblood of a business, the cash generated from operations after accounting for capital expenditures required to maintain and grow the business. Strong and consistent FCF is a sign of financial health, indicating a company's ability to invest in future growth, reward shareholders with dividends, pay down debt, or even acquire other businesses. Unlike net income, which is an accounting measure, FCF reflects the actual cash a company generates. This is crucial for value investors as it provides a clearer picture of a company's financial strength and its ability to create value for shareholders. For instance, consider two companies with similar net incomes. However, one company generates significantly higher FCF due to efficient working capital management and lower capital expenditure requirements. This company would be more attractive to a value investor as it has greater financial flexibility and can reinvest its cash flow to fuel future growth or return value to shareholders. When analyzing FCF, investors look for companies with a history of strong and consistent cash generation, preferably growing over time. They also consider factors like the sustainability of FCF, the company's capital allocation policies, and any potential threats to future cash flows. By focusing on FCF, value investors can identify companies with a solid financial foundation and the potential to generate long-term value. Section 4, Price-to-Book Ratio, PB Ratio, Unveiling Hidden Value in Assets. Imagine you're buying a used car that's in excellent condition but significantly undervalued due to its age or market perception. The price-to-book ratio, or PB ratio, helps investors identify similar opportunities in the stock market. This valuation metric compares a company's market value to its book value, which represents the net asset value of a company as reported on its balance sheet. A PB ratio below 1 suggests that the market values the company at less than the value of its net assets. This could indicate an undervaluation, especially if the company has strong earnings power and a solid track record of generating returns on its assets. For example, consider a company with a PB ratio of 0.8. This means that for every $1 of the company's net assets, investors are paying only 80 cents in the market. This discount could present a buying opportunity, particularly if further analysis reveals that the company is financially sound, well-managed, and operates in a stable industry. However, like any valuation metric, the P/B ratio has its limitations. It relies on historical accounting data, which might not fully reflect the current market value of a company's assets. Additionally, the P/B ratio is less relevant for companies with significant intangible assets, like technology companies, where brand value and intellectual property play a crucial role. Despite these limitations, the P/B ratio, when used in conjunction with other valuation metrics and qualitative analysis, can help investors uncover hidden value in companies with strong balance sheets and undervalued assets. Warren Buffett, the Oracle of Omaha, exemplifies the power of value investing. His strategy focuses on companies with a durable competitive advantage, like Coca-Cola, generating consistent returns. Buffett's emphasis on strong management and long-term perspective has been key to his success. Benjamin Graham, the father of value investing, emphasized rigorous financial analysis. His concept of Mr. Market teaches investors to capitalize on market irrationality. Graham's principles continue to guide value investors, including his famous mentee, Warren Buffett. Peter Lynch's common-sense approach to value investing leveraged everyday observations. His GARP strategy identified companies with strong growth potential at reasonable valuations. Lynch's success with investments like Dunkin' Donuts showcases the power of understanding what you invest in. Seth Klarman's disciplined approach at Baupost Group emphasizes risk management. His focus on margin of safety and extensive due diligence has led to consistent returns. Klarman's book, Margin of Safety, remains a modern classic in value investing. Value investors saw potential in Apple's innovative products like the iPod and iPhone. Despite initial market skepticism, Apple's strong fundamentals led to significant returns. This case exemplifies how value investing can thrive even in the tech sector. During the 2008 financial crisis, value investors saw opportunity in Ford. Ford's prudent management and strong assets led to a remarkable recovery. This highlights the importance of focusing on long-term potential over short-term market fluctuations. General Motors' 2009 bankruptcy presented a turnaround opportunity for value investors. Post-restructuring, GM's focus on innovation and efficiency led to significant growth. This case shows how value investing can uncover opportunities in distressed situations. Value investing remains relevant in today's dynamic market. Technological advancements and passive investing present new challenges and opportunities. Despite these changes, the core principles of value investing endure. Growth investing in tech companies like Amazon and Tesla has captivated investors. Balancing value and growth strategies can mitigate risks and capture upside potential. A diversified approach can be particularly effective in today's market. Value investing is a philosophy grounded in rigorous analysis and long-term perspective. It remains relevant despite market changes, rewarding patience and discipline. As you invest, remember that value investing is a long-term commitment to uncovering true worth.